We analyse hundreds of property deals every single year and reject 93% of them. I know that sounds extreme, but the truth is most investments out there have hidden traps waiting to drain your finances. And over the past decade, we've seen countless investors get burned simply because they failed to check the most important things before buying. So to make sure you don't become a part of that number, I'm going to walk you through the 10 things you absolutely must check before investing your hard-earned money in property, including how to confirm a property's true value and how to quickly identify red flags buried in the legal documents. First things first, I want you to imagine heading off on a romantic getaway with your partner. You've packed your suitcases, you've dropped the kids off with the grandparents, and you've double and triple checked the front door is locked. But instead of heading to a quiet cabin or a luxury hotel, you end up at a 24-hour gaming convention or a budget hostel full of backpackers. Not exactly the setting for romance. You've done all the right prep work, but still ended up missing the most important thing: making sure that the destination fits the goal of the trip. Now, obviously, you wouldn't actually do this, but a lot of investors approach property in this exact way. They decide to invest in property, chase anything that looks like a bargain, only to later realise they've invested in something that's completely out of step with what they actually want to achieve. And I've made this mistake myself. A few years ago, I took on a development project. The potential profit looked great, the numbers made sense, and it seemed like a smart move. But what I hadn't really thought about enough was everything else it would involve. The stress, the constant decisions, the time it pulled me away from running my business. As it happened, costs got out of hand, delays dragged on, and by the end of it, I barely made anything. But even if the project had been a financial success, it still wouldn't have been the right opportunity. Because my goal is long-term growth in a way that doesn't take over my life. And this particular investment would never have helped me achieve that. That's why every property you invest in has to fit your strategy. It needs to not just be a good deal on paper, but the right deal for what you're trying to build. If it doesn't move you closer to your goal, it's simply a distraction. So before you even start looking at numbers, get clear on your strategy. What are you trying to achieve? How involved do you want to be? Then focus on deals that support that direction. By the way, if you want to make sure you don't miss any of the checks on this list, we've created a free beginner's guide checklist that you can download below. It covers the exact steps we walk through with new clients, from getting your finances in order to closing your first deal. Now, let's talk about two investors, Reggie and Mike. Reggie wants to keep things simple by buying a property in his own name. A year later, he's pulling in a decent rental income, but the tax bill at the end of the year comes as a massive shock. Because it's in his personal name, the rental income pushes him into the higher rate band. He's paying 40% tax, he can't deduct the full mortgage interest, and he's at risk of losing some childcare support on top. By the time it's all added up, there's barely any profit left. Compare this to his friend Mike. Mike likes doing things properly, so he speaks to a tax advisor who recommends buying through a limited company. It's more admin up front, but it means paying corporation tax at a lower rate and gives him more flexibility with how he draws income. So far, so good. But there's a catch here too, because Mike's got no desire to build a big property empire. He's just using some inheritance to top up a small income and hopefully retire that bit sooner. So imagine his surprise when he realised that every time he wants to take money out of the company, he has to pay tax on that too. What looked like the smart option on paper is actually costing him more overall. And this is one of the most common mistakes we see. People choosing how to buy a property without really understanding the consequences, only to get stung later on. The structure you choose affects your tax bill, your mortgage options, your exit strategy, and how easily you can scale. And once you've made that decision, changing it normally means paying stamp duty all over again, as well as a whole load of other costs. So before you put in an offer, speak to an accountant who really understands property and understands what you're trying to achieve. They'll help you pick the right setup for your goals rather than someone else's. But as I'll explain in a moment, an accountant isn't the only expert you'll need on your side to get the financials right. Reveal the next person you need to have on speed dial. I need to tell you about the time I found what looked like a brilliant deal in Salford. The numbers were strong, the yield was high, and the area had loads of potential for capital growth. Everything stacked up. Or so I thought, because once my offer was accepted, I went to my broker to arrange a mortgage, which I thought would be a formality. But it was only then that I realised I had a big problem. She explained that because of the way the block was laid out, lenders would be reluctant to touch it. I'd struggle to get a mortgage at all. And even if I did, the terms wouldn't be great. So in the end, I had to pull out of the sale. And not only was it embarrassing, it was a complete waste of time too. And this is something we see far too often. Someone gets excited because the numbers look great. Good yield, strong area, maybe even the opportunity to increase the property's value. But they never stop to check if the property is actually mortgageable, or if they are mortgageable for that type of deal. Some types of property are notoriously tricky. Flats above shops, concrete construction, high-rise ex-council blocks. Most lenders don't like them, but there are more obscure issues too. Sometimes it's a layout quirk, sometimes it's the lease. And that's just the property side. Your own circumstances can have an effect too. Your income, your portfolio size, your recent borrowing history, those are just a few things that can make lenders hesitant to give you the loan you need. So before you even start viewing, speak to a broker about your situation. And when you find a property you like, ask early, can I get a mortgage on this? And how much is it likely to cost me? Don't make any assumptions, because the deal only stacks up if you can actually fund it. And even if you can fund it, that still doesn't mean it's a good deal. Because I often speak to investors who think they've bagged a great deal just because they've knocked a few grand off the asking price. Or they see a developer offering a 15% discount and assume they're getting in below market value. But in most cases, that discount is already baked in, because the asking price was inflated in the first place. It looks like a bargain until you try to refinance or sell and realise the property is not worth what you paid for it. The risk here isn't just overpaying, it's what it does to your whole strategy. If the valuation doesn't stack up later, you won't be able to pull your money out. And if the market softens, you could find yourself close to negative equity from day one. So how do you avoid that? Well, check the land registry for recent sold prices. Not just what's for sale now, but what people have actually paid in the past. If you can't find an exact match, look for the closest comparables, similar size, type, condition, and location. And the less certainty you have, the more cautious your estimate should be. Always base your offer on real data. Not the brochures, not the developer's promises, and definitely not the asking price. But even if you do buy at the right price, you're still not guaranteed a good investment, because there's another thing you need to check, and it's one that too many investors forget, particularly when they're on the hunt for a bargain. Now, don't get me wrong, occasionally listening to your gut will get you a long way in property. It might help you to spot an up-and-coming area before everyone else. Take a chance on an underdog, or sense when a deal feels off, even if viewers are queuing out of the door. But when it comes to working out if a property will actually make money, you can't rely on instinct alone. You've got to crunch the numbers. Too many investors take a quick glance at rents in the area, assume the mortgage is manageable, and convince themselves that there's a decent margin in it, without actually running the numbers in full. Then, a few months in, the boiler breaks, or the letting agent takes their cut, or they market it at what they thought the rent would be, and it just sits empty. And suddenly that £300 a month that they thought they'd be making has vanished into thin air. This is where things often start to unravel. Not because the property is bad, but because they never did the maths. You've got to run the numbers, all of them. That means mortgage, management fees, maintenance, insurance, voids, the lot. Rent is usually the easiest figure to estimate. And crucially, you can't force it to be any higher than the local market allows. So start there. Work backwards from what the property will realistically bring in, not forwards from what you hope it will cover. Because a deal only works if it makes money. And you only know that once you've seen it all laid out. It can be helpful to plug the numbers into a spreadsheet like this one, which you'll find a link to in the description. By the way, in our Beginner's Guide to Investing in Property in 2025, we've got a whole section on how to do this. We also explain how to actually analyse a deal, which can go a long way to helping with the next check. So we often work with investors determined to buy in a familiar place, like the town they grew up in or the city where they went to uni. But familiarity doesn't equal growth. And if you want your investment to actually go up in value, you need to look at what's really happening in the market, not just stick to what you recognise. We still see people convinced that London is the best place for capital growth, even though right now the opposite is true. There's far more potential in regional cities where prices haven't had their moment yet. You also get people chasing the highest yield they can find, forgetting that yield and growth rarely go hand in hand. There's always a trade-off. And rental profit alone is unlikely to build serious wealth. While some investors do buy purely for income, most would be better off aiming for a sensible balance between yield and long-term growth. So how do you find those areas? We'll start by looking at our property hotspots list. That'll give you a short list of regions with strong fundamentals. Then you want to look for mini areas with signs of growth, better transport links, new employers moving in, money being spent on regeneration. Only then will you be in a good position to carry out the next check. And this is one that a lot of investors miss. Too many people assume that because there's a housing shortage across the country in general, they'll find a tenant in days, no matter what the property looks like. But the rental market is far more localised and far more price sensitive than most people realise. We've seen rural properties sit empty for months because there's no tenant base nearby and the transport links are poor. And on the other end of the spectrum, there are areas with very high yields, but you'll find it harder to attract good tenants who'll look after your property and stick around. If you go into it unprepared, things can get stressful very quickly. A high percentage return on paper means nothing if the property sits empty. Long void periods can destroy your cash flow, and they're one of the biggest reasons that landlords panic and sell at the wrong time. So before you put in an offer, speak to a couple of local letting agents and ask them, how quickly could this rent? What kind of tenant would take it? And what level of rent would it realistically achieve? Then go cross-check that against Rightmove or Zoopla, both with and without the let agreed box being ticked. Then you can look at how many properties have rented recently compared to how many are still sitting on the market. It's not perfect, but it still gives you a sense of how fast things are moving. And that brings me nicely on to the next thing on the list. And this one is easy to overlook, especially if you're buying a property where time is of the essence. Take, for example, an investor we know who bought a hoarder's house at auction. They expected a big clean-up job. I'm talking skip hire, clearance, maybe £20,000 in basic renovations. They'd budgeted for the visible mess, but what they hadn't budgeted for was the structural damage hidden underneath the previous owner's belongings. Rotten joists, damp throughout, and signs of subsidence that hadn't been picked up previously because a survey hadn't been completed. And to top it off, the legal pack revealed that the buyer had to pay the seller's legal fees too. The original plan was to refurbish and refinance within 6 months. Instead, this investor spent nearly double what they expected and still couldn't get a mortgage at all. It's all because they didn't dig into the legal pack and didn't ask the right questions before bidding. And this is where many new investors go wrong. They assume their solicitor will flag anything important. But if you're buying at auction, you're already legally committed. Legal issues are one of the most common reasons that deals fall apart, or worse, trap investors in expensive, unworkable situations. We've seen restrictive covenants block plans for HMOs, rights of way disputes that scare off lenders, and missing building control certificates that mean redoing entire parts of a property. So how do you protect yourself? Well, download the title from the Land Registry for £3 and check for restrictive covenants. Look for signs of recent building work and ask for planning permission, buildings regs and warranties. Run a flood risk check using the Environment Agency's free tool. For tenanted properties, get hold of the tenancy agreement and full rental history before bidding. And always read the full legal pack, including the fine print on extra fees. These things will come up eventually, but by then you may have already spent thousands, or worse, committed to buying something that you can't use in the way you intended. So get ahead of it. Ask the awkward questions early, especially at auction where second chances are expensive. And you know what else can be expensive? Not checking this next thing. Because we've all seen a property on Rightmove and it's been love at first sight. Nice flooring, a fresh coat of paint, maybe even a new kitchen. It happens to the best of us. And when it happens, it can be tempting to call up the agent and put in an offer there and then, especially if it's in a competitive area. But the last thing you need is to get the keys and realise that underneath the cosmetic upgrades, the place is falling apart. This is especially common with older UK housing stock. And there's a lot of it. The wiring is 40 years old. There's damp behind the wardrobes. The roof needs attention, the boiler's on its last legs, and suddenly that tidy refurb budget isn't enough to cover even the basics. It's not just about money either. It's time, especially if you have a day job or a business to run. A few unexpected issues can delay everything by weeks or months. So how can you avoid getting caught out? Well, if you're buying a modern house or flat, you'll usually be fine, but stick around for the last check just to be on the safe side. But for anything older, or for anything that's been extended or converted, you need to be doing a proper check. Unless you're very confident in what you're looking at, get a level 2 RICS survey. And for much older or heavily altered properties, go for a level 3. And if you're planning to do any kind of refurb, get written quotes from tradespeople before you exchange contract, not after. Because the numbers only stack up if the condition does too. And this ties in nicely to the final check on the list. While some issues can be hiding behind walls or under floorboards, sometimes the real problems are buried in the paperwork. Because even if the property itself is in great condition, the lease, the service charge, and the block management can turn a solid investment into an expensive headache. An investor we know picked up what looked like the perfect flat. It was a modern apartment, no decorating needed, ready to rent. The block had a beautifully maintained shared garden, was walking distance from the station, close to good schools, and sat in one of those rare areas with both strong demand and decent yield. It seemed like a bargain. But once the legals got underway, the problems started to emerge. The lease had a ground rent clause that doubled every 10 years, something that most lenders now won't touch. The service charge, which looked reasonable at £1,200 a year, came with a warning of major external works that were planned, with the cost being passed straight on to the leaseholders. And the managing agent, slow to respond, difficult to deal with, and rated 1 star on every review site going. The flat itself was fine, but the lease, the costs, and the management mean that it would be hard to finance, hard to sell, and more expensive to hold than expected. This is where a lot of people slip up. They focus on the property and ignore the paperwork, especially when the flat looks clean, modern, and ready to go. But short leases, escalating ground rents, and poor management can kill a deal just as easily as structural problems can. So if you're buying a flat, here's what to check. Lease length. You want well over 80 years. Below that, mortgage options shrink and extending gets pricey. Ground rent terms. Avoid anything with doubling clauses, or where the ground rent is over £250 outside London. Service charge history. Ask for the last few years and check for any planned works. Expensive stuff like roof repairs, cladding, lifts and windows. And managing agent. Look up the company. If they've got a terrible reputation, you'll inherit their problems. Flats can make great investments, but only if the lease, the costs and the management are just as solid as the property itself. Now, getting these 10 checks right will protect you from most property disasters. But there are still some clear signs that buying property right now might not be right for you. Because even a perfect deal can become a nightmare if your timing is wrong or if your personal situation doesn't fit. So before you make your next move, watch this video next, where I reveal the 6 signs that you shouldn't buy property in 2025 to avoid making an expensive mistake.